Good morning, PFIN students. Here we are in Module 2, Day 2, and you'll see that on this day, it looks a lot like every other. We're in Chapter 5, Section 5.3 to 5.6, studying the housing decision. You're going to watch a lecture, and within that lecture, you're going to learn a lot about mortgages. And then you're going to complete a workshop, which is going to have you figure out in your years going forward after college, how much house you can afford in, say, 5 years, or whenever you decide to buy a house. Based on your income and what you want in a house, we're going to figure out how much you can afford. Chapter 5 homework will be live. That's going to include the automobile stuff from yesterday, as well as the housing decision stuff for today. And don't forget to contribute to your discussion group today. All right, here we go. Mod 2 Day 2, the housing decision. So what we're going to talk about is different choices for lodging. We're going to learn the costs of buying a house. So for many people, the house is the biggest financial decision of their lives. And so there's a lot of details that go into buying a house. We're going to learn what those are. Most of the time, people don't pay cash for their house. They get what's called a mortgage. And so we're going to talk about the different types of mortgages available. In the end, like I said, you're going to compute how much house you can afford given your workshop. So to do this lecture, you need to go find the good faith estimate and, of course, the slides that are on Georgia View. So once again, in our Day 2 section of the module, under lecture materials, you'll find the slides, the video, which I'm recording now, and our handout for the day. You'll also find the workshop. Get to the end of the lectures, and I'll talk you through how to do the workshop correctly. So look for that at the end of this. All right. So what type of housing fits your needs? Well, generally, there's a few different types. When we think about buying a house, we think of what's called single-family homes. These can be standalone homes that you see like in subdivisions, or row houses in crowded areas. So when my wife lived in Pittsburgh, on the south side of Pittsburgh, all the houses, you couldn't fit between some of them. They were so close together. They weren't touching walls or sharing walls, but they were that close together. We call them shotgun houses, where you could shoot a shotgun in the front door and it would exit out the back door. This is actually the house from Full House. This is the row house from the show Full House. I don't know if you all are too young to know what that is or not. But why do people choose single-family homes? Well, I'd say the overwhelming majority of people want privacy. They don't want to share a wall anymore. They don't want to share common spaces with people that they don't know, and so they like that level of privacy. And also the level of property control, to be able to do whatever you want to your house and not have to fix it before you move out or whatever. And lastly, there's a little bit of pride with home ownership. It's the American dream, if you will, to own a home, or maybe it used to be, but you get pride from owning something. However, it doesn't make sense for everyone to buy a single-family home, and so we're going to think about the other options too. So if you don't want the responsibility of caring for your large property and you don't mind the lack of privacy, you might consider condominiums, cooperative apartments or co-ops, and rental housing. So these are the condos that are down at the country club here in Milledgeville. And so what goes on with condos? Well, you buy a condo just like you buy a house. You can take out a mortgage and you own that individual unit. However, the way that a condo differs is that the outside areas of the condo, so not the stuff within, like your washer, dryer, refrigerator, walls, whatever, the stuff on the outside is jointly owned by everyone else in the condo complex. And so you don't have to take care of it. Instead, what you do is you pay a monthly fee, kind of like paying rent, but much, much smaller, to the condo association, and they maintain the surrounding areas of the condo. Everything inside is yours, everything on the outside is shared and maintained by the condo association. People like condos. You can get a lot more house for lower cost per square footage. And you're not really responsible for maintaining the outside of the building. We kind of talked about that. The way that works is the people who live in the condo are going to elect a board of managers who will make decisions on capital improvements to the building and things like that. Then we have cooperative apartments. You'll see these a lot more in big cities. And so these might seem strange to some people. They look and feel kind of just like apartments, but they also share some attributes of condos. So we're going to compare them to condos first. When you buy, I'll say buy, when you buy it, what do you own when you own a co-op apartment? Well, you own a share of a company. So a company owns the whole building, and you buy a share of that company. So essentially, all of the people who live in the cooperative apartments in the co-op own a piece of the corporation that is the building. So you are a member. Like a condo, you have shared living space that's maintained by the by the corporation that owns it, and you pay a monthly fee based on how many shares you own. You own more shares usually if you have bigger rooms or whatever. I say maybe more space, more bedrooms, what have you. But you pay a monthly fee to maintain the building. But unlike a condo, you don't own the unit you live in, which means that each tenant is just a part owner of the entire building, not an owner of their own place. Different from an apartment, though, in which, a rental apartment, you don't own anything at all. You get to vote on management and financial decisions for the building. So, for example, if we need to update all appliances throughout the rooms in the co-op, you would go for a vote, and then it would be voted, and then all of the appliances would be changed. The other thing that differs from a condo, and condos might have this as well, but it's definitely true for cooperative apartments, because sometimes co-ops are for particular people, like young professionals. There will be a membership committee approval, so you have to apply to live in a co-op and be accepted by the membership committee. At the end of your time living there, you simply sell the share back to the corporation or to someone else, but you do not get, but you don't own the unit. You own a share of the company. And then lastly, there's rental housing. You don't own anything, and so this is most appropriate for basically you guys. You don't have a big down payment to be able to buy anything. You're unsettled in your job or family status. You might move soon. And you don't really want to take care of like a large lawn or something if it breaks down. Okay, so regardless of the different types you're going for, we're going to think about buying either a house or condo. So what goes into the home buying decision? For this discussion, I am going to talk about the mortgage, and you're going to want to look at what's called a good faith estimate. So have this pulled up as I'm going through the slides. I'll reference it often. When you're buying a home, there's 5 costs to consider. The first is your down payment. Down payment is how much money you bring to the table for closing. And so when you sign the line to buy a house, when you take over the mortgage and you buy the house, that's called closing. A down payment is a fixed amount of money that represents your automatic equity in the house. So if the house is $250,000 and you have $20,000 to pay down payment, you will only have to borrow $230,000. You already have $20,000 equity in the house. That's your down payment. Points and closing costs. We're going to explain these in a minute, but these are different fees that get tacked on to obtain the house through a mortgage. And these are going to be all due at closing when you sign the dotted line. Then you have mortgage payments and property taxes and insurance, and these are going to be and maintenance, and these are going to be things that you pay throughout the year. Okay, so what can you expect when you go to get a mortgage? Well, you'll contact a lender, and you'll give them some basic information about how much you make, what size house you're looking for, etc. And they're going to give you what's called a good faith estimate. And this good faith estimate, if you look in front of you, has a breakdown of all of the costs of the mortgage, all the costs of the unit of the house, and so we know exactly what we're going to pay on closing day and going forward in our loan payments. So let's break it down piece by piece. The down payment. This is the buyer's equity. You're going to pay this at the time of closing, and people typically pay 5 to 20% of the purchase price of the house. So if you take a look at our good faith estimate, let's go to the back page. The very back page has total estimated funds needed to close. So we see that this house is $250,000, and the person's only borrowing $237,500. So how much is the down payment this person's bringing to the table? Well, you simply take the difference between what they're borrowing and what the house costs, the price of the house, and you see that they're bringing $12,500 down payment. Now, what's interesting about the down payment is banks use this as a signal of your financial strength and security. So if you can't make a 20% down payment on the house, lenders may require you to buy private mortgage insurance. This isn't housing insurance. So this isn't like the insurance you get in case a storm blows your house down. This is insurance that protects the lender if you default. If you can't make your payments, the insurance company makes payments on your behalf to the lender so they don't lose money. But you pay the premium. So if you put down less than a 20% down payment, you're going to add on to your monthly payment a mortgage premium for mortgage insurance. And this will continue until you get all the way up to 22% equity in the house, so just over 20%. Then it will go away and you don't have to pay the insurance anymore. So let's take a look back at the good faith estimate again. $12,500. Can you tell me, is this person paying principal mortgage insurance? Okay, you should say yes. If we can see that $12,500 over $250,000 is not 20%. In fact, it is only 5% down. So if we look over here to the right, in the monthly payment section, we see a line item for monthly mortgage insurance, and this person's paying $85 a month for mortgage insurance because they can't make a 20% down payment. Okay, email. Just close that. All right, down payment. Second thing you'll see, cost of a home, is points. Now these were very confusing when I bought my first home, so this is very useful that you're learning this. These are prepaid interest payments to the lender. So the lender is going to have an interest rate on your loan, and you'll pay interest over time. However, points, if they allow you to do it, will get you a more favorable interest rate. It will lower your interest rate, but you're paying interest up front. And so it's kind of like if you have more money now and you want to reduce your monthly payments, you can do so by buying points. 1 point is equal to 1% of the loan amount. So whatever you're financing, 1% of that, not 1% of the house's value. We'll do an example. You can usually buy between 0 and 3 points, and the amount that it reduces your rate just depends on what the bank is offering you. So you'll have to just look that up. And what's interesting about points is since they are interest, and you remember that house interest is tax deductible, these points are also going to be tax deductible in the year you buy the house. So let's do an example. Suppose the lender offers you points. You are looking at a 30-year mortgage of $165,000. So you're borrowing $165,000. You have a 6% interest, and you have no points. So payments would be $989. Now they offer you the option to buy 2 points. 30-year mortgage, $165,000, but it lowers your interest rate to 5.5%, lowering your payments to $937, right? You could do this time value of money calculation if you wanted to. So, first question I have, How much will you pay in points for these 2 points? How much did they cost you? Give that a try. Pause it if you need to. Okay, each point is 1% of the loan amount. You're borrowing $165,000 and you're paying 2 points to get that interest rate. So 165 times 2 percentage points, or 1 point is 1%, so 2 of those, $3,300, what you have to bring up front. So what's interesting is you want to think, okay, is it worth it? Should I buy points or not? Well, you have to decide how long you're going to live in the house. You're going to save $3,300 from the interest rate reduction. So you want to see if the lower payments, how long you have to live in the house with the lower payments to make that money back. And ignoring the opportunity cost of interest rates, ignoring time value money, $3,300, $52 a month is what you save. Notice the difference is 52. So each month you save $52. When does that get up to $3,300? In 63.46 months. So almost 5 1/3 years, 5 1/4 years about, right? So you need to stay in the house more than 5.28 years to save more than what you spent up front on points. Now, where do we find this on our good faith estimate? Excuse me. We'll see here is the loan, the finance amount. There's their APR. 360 months is the loan. And the discount, 1% per point. If they're paying $2,375, how many points do they buy? Here's the loan amount, 1% per point. That's how much they're spending. How many points are they buying to get this interest rate? Pause it if you need to. Okay, they're buying 1 point because 1% of the loan amount is $2,375. So they've bought 1 point, prepaying this amount of interest to get that lower interest rate. All right. Next, on the good faith estimate, closing costs. These are expenses to close on a home, and they can include lots of things. Loan application and origination fees. Points, we've already talked about those. Title search and insurance. Attorney fees. And so what I'm saying here is title insurance, not house insurance. You actually can insure against, so you get a title to your house, and it states, the house is in good condition and Justin Roush owns it. Title insurance insures me against the risk of the title being voided because there's something incorrect in the paperwork. Weird. Attorney fees, you got to pay an attorney to broker the closing. Appraisal fees, you have to pay somebody to verify the house is worth what you're borrowing. So if you want to go borrow from the bank and you've agreed on some high amount and the appraisal is actually very low, the bank is not going to approve you for that loan because if you ever default, they're not going to make back that money. And then you'll have a bunch of other miscellaneous fees, and you'll just have to ask lots of questions. And then the very last thing is you'll prepay stuff into escrow. I'll talk about what that is in the next slide. So don't worry about escrow right now. But let's go check out some of the closing costs over on the good faith estimate. So fee. You get fees everywhere when you buy a house. Processing fee, right? Vague enough. Underwriting fee, wire transfer fee, appraisal fee. All these things have to be paid for prior to you buying the house. So when you're thinking about saving for the house, it's not just the down payment that you need to save for, but also these things as well. Down here in the title charges section, we see document preparation fee and attorney fees. That comes to getting everything ready for your closing, so the hours of work that go in for that. Here's title insurance. Here we got our taxes that we have to pay at closing. Okay. Finally, we're through our upfront costs, down payment and closing costs. Now, so one thing that you can actually negotiate is splitting up some of the closing costs with the seller of the house. So if you don't have a large down payment, you might say, hey, you pay all the closing costs and I'll buy your house. So you can negotiate these things. All right, now let's get to the part that's not paid up front. This is what you're going to pay over the life of the loan. And so one way to remember this is, oh, what a pity, I'm paying so much money for a house. Well, PITI. The mortgage payment that you make every month is composed of principal, interest, taxes, and insurances. Principal is the amount of your payment that goes to reducing the balance on your loan. Interest is the finance charge that the bank is charging you. Taxes and insurance. So you heard me mention escrow earlier. Right? In the last slide I said you have this escrow cushion. So what escrow is an account. And throughout the year, you pay amounts into the escrow so that at the end of the year, the bank will just take money out of your escrow and pay taxes on your behalf. And they'll take the money out of your escrow and pay insurance on your behalf. The bank doesn't trust you to save enough money to pay these things. And they're worried that if you don't save money and pay these things, you'll not give them their principal and interest in default on their loan. So by giving you the loan, you agree to pay this to them, but you also agree to prepay these things into escrow so that the bank knows that they'll always be there. So these things all together are going to be what goes into your monthly payment. So let's take a look at these. If you go to the good faith estimate at the bottom, you will see your total estimated monthly payment. Here's principal and interest. That's the amount that's going to be applied to your loan every month you pay. Hazard insurance is your homeowner's insurance. This is what you have in case there is a storm or a disaster that hurts your home. Real estate taxes, that's how much you're paying into escrow. Also, hazard insurance. Both these things are going into escrow to be paid at the end of the year. And then we have mortgage insurance. This is because the buyer does not have 20% down. So all these things go into escrow so that they're always there to pay the insurance companies and the taxes when those things are due. At closing, you're going to have some of these things up front. So when you buy the house, the mortgage company makes you buy the entire first year of insurance. And so you'll notice so you have to pay that up front. And then you put money into the account each month until your insurance is due again, and then they'll pull that amount out of there. And so let me run a quick calculation here. So you'll notice that this is 1 month at $40. This is 12 months at $480. So you pay for the entire first year at closing, and then every month this goes into the escrow account. And then when next year rolls around, you will have a withdrawal from your escrow account that pays for your insurance. The lending company also requires you to keep a certain level of cushion in your escrow. So if you stop making payments, they want money to be there to pull out of your account so that they still get their money, and the bank doesn't, and so they still get their money. And so you'll see here they require 3 months of the hazard insurance premiums, $120, 3 months of the mortgage insurance, and 3 months of the taxes contribution. So you'll have to put all those things in up front as well. Okay, so principal and interest, taxes and insurance. Principals and interest go directly to the bank each month. Taxes and insurance go into escrow, and they are paid out of escrow when they are due. One thing you'll notice about your loan payments, if you look at a 30-year, or this is a 25-year, or sorry, this is a 30-year mortgage, your annual payments are $6,441.84. And this graph is plotting the amount of that goes to principal versus the amount that goes to interest. And you'll notice that the overwhelming majority of your payment, almost $5,000 of your first payments, goes to freaking interest. Down here at about $1,500 is only the amount that goes to principal. So you're not really paying off your loan very much. But slowly over time, as your loan balance decreases, the amount of interest charges goes down. And so more and more of your payment goes to the principal and less to interest. What this means for tax purposes is that your biggest itemized deductions, remember those, from interest payments are going to come here in the beginning of the life of the loan, and they'll get smaller into the future. All right, so in order to get a mortgage, I think that's everything I wanted to talk about with. All right, so before we move on, let's do one more thing on the good faith estimate. So in total, what you need to close is the loan, your down payment of $12,500, your estimated closing costs, all those fees, and then your estimated items and reserves, which is the total of that cushion, right? So the house needs $20,946 to close, even though this person is only paying $12,500 down. All right. So in order to get a mortgage, you have to be able to qualify. And you remember that I kind of mentioned banks looking at your debt service ratio. Well, the first benchmark to be able to get a mortgage is banks are generally going to require your mortgage to be no greater than 25 to 30% of your monthly gross income. Additionally, they're going to require all of your loan payments to all consumer loans to be less than 33 to 38%. So this means all of your payments going to car, house, a furniture loan, all other loans you have to be less than 33 to 38%. They want you to be solvent. They don't want you to run into trouble and not be able to pay them. So in order to give you a mortgage, you have to have low levels of debt. The final thing you need to think about with a home, operating expenses, right? So water, trash, electricity, and gas. Just because you can afford the mortgage payment doesn't mean you can afford the mortgage payment and all the accessory payments. Electricity can be quite high in Georgia in the summertime. Also, upkeep expenses and repairs. These are very hard to forecast. Painting, lawn maintenance, depreciation. You want to do the best you can. And so one thing that I do is we build in to our monthly or our annual cash budget on a monthly basis a little payment towards household upkeep to make sure that we have funds available for when things wear out. There you go. Okay, let's take a little break. When we get some more coffee, we'll come back and discuss types of mortgages.